In today's video, we're going to go over above-the-line deductions, also known as adjustments to income. These are tax breaks that lower your taxable income, which means you could pay less in federal income taxes, potentially saving you hundreds, if not thousands, depending on your situation. If you're new here, hi, my name's Alex and I'm a certified public accountant. I enjoy making videos on tax planning and personal finance, and how to keep more of your hard-earned money by paying less to Uncle Sam. If that sounds helpful, please hit that subscribe button so you don't miss out on future tips. Before we dive right in, let's quickly break down how federal income tax is calculated. This will help you see where these deductions fit in. Here's the basic formula. Gross income minus above-the-line deductions, aka adjustments, equals adjusted gross income. Then you'll take this adjusted gross income, aka AGI, and subtract either your standard deduction or your itemized deductions to arrive at your taxable income. Your actual federal income tax is based on that taxable income amount. In today's video, we're focusing on those adjustments, the above-the-line deductions that come before your adjusted gross income. I recently made a video comparing the differences between the standard deduction and itemized deductions, so if you're interested, I'll link that in the video description down below. Now, these adjustments to income will go on Schedule 1 of your Form 1040 and can be found on page 2. Let's jump into each deduction one by one. The first is your student loan interest deduction. If you paid interest on a qualified student loan for yourself, your spouse, or a dependent, you can deduct up to $2,500 per year. Note that income limits apply to this student loan deduction. If you're single, your phase-out begins at $80,000 of income and ends at $95,000 of income. And for married couples filing jointly, the phase-out starts at $165,000 of income and ends at $195,000 of income. For this deduction, you also can't be claimed as a dependent, and the loan must have been used for qualified education expenses. Next up, we have traditional IRA contributions. If you contributed to a traditional IRA, your contribution may be fully or partially deductible, depending on your income, your filing status, and whether you or your spouse are covered by a retirement plan at work. For 2024, you can contribute up to $7,000 to a traditional IRA, or $8,000 if you're age 50 or older. The next deduction is for health savings account. If you contributed to a health savings account and you're enrolled in a high deductible health plan, otherwise called an HDHP, contributions to your health savings account are deductible. Now, the limits for 2024 are $4,150 for individual coverage and $8,300 for family coverage, plus an extra $1,000 if you're 55 or older. Quick note, if your health savings account contributions were made through payroll deductions, they're likely already reflected on your W-2 Box 12 Code W. But if you made contributions directly outside of work, you'll report them on Schedule 1 to claim this deduction. Next on our list is educator expenses. If you're a K-12 teacher, counselor, principal, or aide and worked at least 900 hours during the school year, you can deduct up to $300 for out-of-pocket classroom expenses. And for married educators filing jointly, they can each claim $300 for a total of $600 deduction. Next is moving expenses for active duty military. This only applies if you're active duty military and you moved because of a permanent change of station. You can deduct reasonable costs for moving household goods and travel and lodging. Next on our list is the self-employment tax deduction. If you're self-employed, you pay both the employer portion and employee portion of Social Security and Medicare taxes. But you might not have been aware that you can deduct half of that amount, and it's calculated automatically when you file Schedule SE. Self-employed retirement contributions. If you contribute to a SEP IRA, a simple IRA, or a solo 401k, those contributions are deductible. For example, with a SEP IRA, you can deduct up to 25% of your net self-employment earnings up to $69,000 in 2024. The actual limits vary based on the plan and your income, so check the IRS rules or consult with a tax professional for your specific case. Moving along, we have the self-employed health insurance deduction. If you're self-employed and paid for health, dental, or long-term care insurance, you may be able to deduct those premiums for yourself, your spouse, and your dependents. Now, there are a few conditions. The deduction can't be more than your net business income, and you can't claim this if you had access to an employer-sponsored plan, even through your spouse. The next deduction is penalty on early withdrawal of savings. If you cashed out a certificate of deposit or time deposit early and paid a penalty, like an early withdrawal fee, you can actually deduct that penalty amount. You'll typically see it reported on Form 1099 INT or 1099 OID. The next deduction is for alimony paid. If you're paying alimony under a divorce or separation agreement finalized before 2019, those payments are deductible. Now please note, this does not include child support or voluntary payments, and after 2019, alimony is no longer deductible. Now this one is rare nowadays, but next up we have our Archer MSA contributions. If you have an Archer medical savings account, kind of like an HSA, contributions may be deductible if you're enrolled in a high deductible plan. Now with that being said, MSAs are rare these days, and most people use HSAs instead. So there we have it, a full walkthrough of all the above the line deductions, aka adjustments, available as of this video. These can make a big difference in lowering your taxable income, so take the time to see which ones apply to you. Thanks for watching. If you found this helpful, please adjust that like button and subscribe for more practical tax and money saving tips. See you in the next video.